Hello, everyone, and welcome back to the Deep Dive.
Hello.
I hope you are locked in, caffeinated, and ready for what is, I think, perhaps the single most important technology analysis we could possibly do this year.
Oh, absolutely. It's the one everyone is asking about, the company that has become the foundational layer for this massive technological shift we're all living through.
That's right. Today, we are breaking down the accelerated computing giant, NVIDIA. And over the last decade, we've just watched this company, once known mainly for, beautiful graphics and PC games, execute a pivot so profound it has. Well, it's redefined what a semiconductor company can even be.
They're not just selling graphics cards anymore.
Not at all. They are the core, the foundational provider for global AI infrastructure.
The scale of that pivot is, you'd be hard-pressed to find another example like it in corporate history. They went from optional consumer hardware to essential infrastructure utility in, less than 5 years?
It's incredible, and it just fundamentally changes the economic rules they play by.
It does.
Which, leads directly to our central culprit, the whole mission of this deep dive today. Is NVIDIA's staggering, truly generational valuation, is it fundamentally supported by a permanent, unassailable competitive advantage?
A real durable moat.
Exactly. A moat that will withstand the gravity of competition. Or is the market drastically underestimating the inevitable cyclical nature of this industry and, maybe more importantly, the self-funded competition that's now coming from their biggest customers?
That's the billion-dollar question, isn't it?
It is. And we promise by the end of this to identify the precise points of risk that could permanently impair that bullish thesis.
That is a massive question, and one we need to approach with some serious intellectual rigor to get to the bottom of it. But before we get into the details, the software lock-in, the crazy financial metrics, just a quick note for everyone watching.
Of course. For those of you who want to act on this kind of deep research and, actually execute on your ideas, having a professional-grade platform is it's key.
Absolutely essential.
We use Interactive Brokers for our trading and our own deep research, and we've actually partnered with them to get our viewers a stock bonus when you sign up and fund an account through our link.
So you get a bonus to jumpstart your portfolio, and you support the channel at the same time, which helps us keep doing this level of in-depth analysis.
Right.
That link is, of course, right there in the description just below the video.
That's right. And of course, if you find value in this kind of critical, in-depth discussion, if it delivers those, moments for you, the best way to let us know, and to make sure you get to the next one, is to subscribe and hit that like button.
It really does help the channel.
It does. And if you have any questions about the company, please manifest yourself in the comment section.
Perfect. Now, let's jump into the core analysis. Pillar number 1. The business model and the technological flywheel. This is where we define the exact nature of their economic power.
Okay, let's unpack this shift. We have to start, I think, by just grounding ourselves in this dramatic revenue pivot.
Right.
If you look back maybe 7 years ago, NVIDIA It was synonymous with GeForce.
Gaming. Yep.
Gaming was the core economic engine. It was their brand identity. And today, don't get me wrong, it's still a massive revenue stream.
Sure, a very healthy business.
But it's almost a secondary consideration compared to the data center segment.
The change is it's tectonic. And the transformation isn't just about the numbers growing. It's the qualitative nature of that revenue stream itself that's changed.
What do you mean by that?
The dominant source of profit and revenue has shifted so massively, so consistently, and so decisively to the data center. This is the segment that sells the advanced GPU accelerators, the compute engines, like, the current Hopper architecture.
Which is already giving way to Blackwell.
Exactly, which is now yielding market share to the rapidly deploying Blackwell platform. The pace is just relentless.
Let's pause on that hardware for a second because it's so important to understand it's not just the chips.
No, not at all.
It's the full solution. They are selling the GPU accelerators and these high-speed networking solutions like Infiniband and Spectrum MX. Why is that networking piece so critical to their advantage?
Okay, that is a fantastic question and a key distinction that I think the market sometimes misses.
Right.
When you are training a massive, modern, large language model, think trillions of parameters, you're not using one GPU, you're using thousands. Thousands of them, all clustered together, basically functioning as one single massive supercomputer. The problem is, as the computation gets faster and faster, The communication between those chips becomes the bottleneck.
Ah, so your system is only as fast as its slowest link.
Exactly. And standard Ethernet is just, it's too slow. It's too inefficient for this kind of work.
So that's where Infiniband comes in.
That's where Infiniband comes in. They acquired it with Mellanox, and it's a proprietary, extremely low latency, high bandwidth communication protocol. It makes sure that those thousands of chips in the cluster can talk to each other almost instantly. Without it, you would just waste massive amounts of compute time waiting for data to transfer.
So by integrating that piece directly into their platform, making it a proprietary optimized component.
They move from selling a great chip to selling a mandatory solution. It's a full stack sale.
And their customers for the solution, we're talking about the core infrastructure builders of this whole AI revolution.
We're talking about the hyperscalers, Google, Microsoft, AWS, who need to provide cloud AI services.
And the big enterprises.
And the major enterprises building and deploying their own foundational AI models. I mean, these are the titans with billion-dollar budgets. And for them, this demand is completely non-negotiable.
So the core monetization strategy, despite all this complexity, is actually pretty simple.
It is. They're selling the engine for the world's most complex computational tasks.
And they monetize that technological lead through premium pricing on these full-stack solutions.
They don't have to compete on price because there's no functional equal in the market today. The structural trend, this exponential demand for accelerated computing, it just means their model is essential and their pricing power is incredibly robust.
Okay, this is where it gets, for me, really interesting.
Yeah.
This is where the competitive advantage truly solidifies. Let's talk about the moat.
Right.
It's not built on silicon, is it? It's built on software gravity.
That's the perfect way to put it. The primary economic moat here is a combination of extraordinarily high switching costs coupled with massive intangible assets.
Okay, intangible assets like their brand, their R&D lead.
Exactly. Their brand prestige, their decade-plus lead in specialized R&D. But the impenetrable wall itself, that's called CUDA.
CUDA, the Compute Unified Device Architecture. For the listener who isn't writing code every day, we need to break this down beyond it's a programming model. Why does this proprietary platform act like economic gravity?
Okay, so think of the GPU as this incredibly powerful, specialized piece of hardware.
Right.
CUDA is the operating system for that hardware.
Ah.
It's a parallel computing platform and a programming model that lets developers tap into the GPU's power for general-purpose tasks, AI training, simulations, rendering, you name it.
So it unlocks the chip for things other than just video games.
Precisely. And crucially, the major AI frameworks, we're talking PyTorch, TensorFlow, and all the specialized libraries that drive them, have been optimized and built specifically for the CUDA architecture over the last 15 years.
So you're saying it's kind of like an entire proprietary ecosystem, almost like the relationship between Apple's hardware and the iOS operating system?
That is the perfect analogy. CUDA is the iOS of accelerated computing. We are talking about millions of developers, engineers, and researchers across the globe who've invested years, sometimes their entire careers, building applications, algorithms, and these vast libraries on this single, unified stack.
Libraries like CUDA or CUDA?
Exactly. CUDA for deep neural networks, CUBA is for linear algebra. All that investment creates this massive gravitational lock-in.
So, in practice, let's make it real. What does that switching cost actually look like for a major customer, say Microsoft?
It's crushing. It's absolutely crushing. Let's say Microsoft wants to move a significant AI workload off NVIDIA's chips and onto, say, AMD's RCM or maybe their own custom internal chip.
Okay.
That decision is not a simple hardware swap. They would have to fund massive internal teams to rewrite potentially billions of lines of production-level code that has been fine-tuned for CUDA kernels.
Billions of lines.
And they face performance degradation risks. Critically, they lose access to decades of debugging and maturity that's built into the existing CUDA libraries. They have to retrain specialized engineering teams. The cost, the time, the risk, it's all so high that it makes the hyper-premium price of the NVIDIA hardware actually the cheaper option.
Wow.
That friction, that's the fortress wall.
And this advantage isn't static, right? The moat is actively widening. We see the data center segment just dominating. It's approaching, what, 88% of current revenue?
Yep.
As they shorten the product cycle to this almost unbelievable annual cadence hopper to Blackwell, they just deepen the dependency.
And that dynamic leads directly to this mental model of the technological flywheel. It's a self-reinforcing loop, and if you understand this loop, you understand why their growth isn't slowing down, but in some ways, it's actually accelerating.
Walk us through that mechanism step by step.
Okay, it all starts with performance and prestige. Step one. The top AI researchers and companies, the ones solving the absolute hardest, most computationally complex problems,
The pioneers.
the pioneers. They are naturally drawn to the most powerful, most mature, and most reliable platform available. And right now, that's the combination of the fastest hardware and the most robust software, NVIDIA and CUDA.
Okay, so step two. Their work then leverages that platform.
Correct. Their breakthrough work creates new, more powerful, and often way more computational demanding applications. Things like larger language models, multimodal AI, complex drug discovery simulations.
Which in turn.
Inherently increases the demand for the next generation of hardware because the existing hardware immediately becomes insufficient for the new breakthroughs.
And this feeds the reinvestment cycle.
Exactly. Step three. That massive sustained demand funds equally massive R&D. We're talking billions and billions of dollars every year.
Right.
And that money is intelligently deployed not just into the next chip, but into optimizing the CUDA stack, releasing new libraries, integrating that networking piece even deeper.
And the final step makes the loop spin again.
Step four. This R&D makes the next platform, whether it's Blackwell or whatever comes next, even more powerful, more efficient, and even more attractive to the best researchers and the largest enterprises.
It's a virtuous cycle.
A virtuous cycle of innovation and funding. It continuously widens that performance and software gap, creating a self-sustaining competitive advantage that the competition just can't easily break.
But this isn't happening in a vacuum. We do have competitors. So how do the direct competitors, like AMD and Intel, how do they stack up against this flywheel?
Well, they're basically trying to catch a moving train. AMD, with its MI series GPUs and the ROCm software stack, is trying to position itself as the cost-effective alternative.
Okay.
Their main appeal is to data center customers who are, suffering from the supply constraints and the high cost of NVIDIA and just desperately want some vendor diversity.
But ROCm isn't quite there yet.
It's improving rapidly, but no, it still lacks the maturity, that decade plus of optimization, and just the sheer volume of developer resources that CUDA commands.
And what about Intel?
Intel's strategy is a little different. They're trying to leverage their immense scale, their established relationships with enterprise clients, and their full hardware stack CPUs, AI chips, their own GPUs. They're trying to offer a comprehensive one-stop shop solution.
But they're playing catch-up.
They're still playing significant catch-up in this specialized AI and GPU computing space.
Now let's go back to what you called the Trojan horse, the hyperscalers themselves. Google, AWS, Microsoft. This feels like the critical long-term threat.
It is the critical distinction to make because their chips aren't designed to compete in the general market, at least not yet.
So Google has its TPUs, AWS has Trainium.
And Inferentia, right. These chips are designed for their own internal cloud infrastructure. They exist primarily to manage two things. First, to bypass NVIDIA's premium pricing on their own workloads.
Makes sense.
And second, to guarantee supply and customize the chip for their specific cloud architecture needs. So for now, they are primarily internal cost control mechanisms, but they represent a massive subsidized internal competitor that is growing in sophistication every single year.
This brings us right back to customer sentiment. You called it the loved but locked-in dynamic.
I did.
And that, to me, speaks volumes about the scarcity premium they command.
It's the perfect description of a highly durable economic bottleneck. I mean, customers are frustrated by the astronomical costs. They're frustrated by the supply constraints. They are literally begging for more volume.
But they can't leave.
Their businesses literally depend on the performance and the reliability that the CUDA platform provides. The fact that demand is limited by NVIDIA's capacity, not by the underlying market need, gives us the clearest possible financial signal. This product is, at this moment in time, irreplaceable.
Okay, so we've established this unparalleled technological bottleneck and the deep, deep software lock-in. But, great technology can be ruined by poor capital allocation.
It happens all the time.
So who is leading this machine? Let's pivot now and look beneath the hood at the management, the stewardship, and just the raw financial quality of this business.
And you have to start with Jensen Huang. I mean, his tenure is one of the longest and most stable in the entire industry.
Right.
He operates with an owner-oriented mindset, not a managerial one, and he has displayed just flawless execution of a single multi-decade strategic vision, which is accelerated computing.
I love his philosophy. Strategy is what you do. It puts all the emphasis on execution over just rhetoric. This is not a company that chased trends.
Yeah.
They saw the potential of the GPU as a general-purpose processor long before the AI boom made it obvious to everyone else.
And that, right there, brings us to the rationale test for capital allocation. For over a decade, NVIDIA poured massive, disciplined R&D dollars into CUDA.
Right.
They often sacrificed short-term profits and took a lot of criticism from analysts who they didn't understand the long-term play.
It was a very contrarian bet on the future of parallel processing.
Precisely. And that patient, massive, and ultimately successful spending on the CUDA software ecosystem proved to be the single most rational capital allocation decision in the company's entire history.
While competitors were optimizing for the existing market.
NVIDIA was building the foundation for the next market. That kind of visionary foresight is it's incredibly rare.
But let's introduce some critical skepticism here. I mean, while Huang is clearly a generational leader, that kind of multi-decade control, that also introduces some inherent risks, doesn't it?
Oh, absolutely. We have to acknowledge the key man risk. When a single individual is so deeply identified with the long-term vision, the strategy, the product roadmap, when he is essentially the face of the technological future, any unplanned transition introduces massive uncertainty and instability.
So even if succession planning is happening, the market's going to be nervous.
The market will always question whether anyone else can maintain that specific combination of technical genius, strategic conviction, and execution speed. It's a real risk.
Okay, moving to disciplined capital allocation. We know R&D is the top priority. It's the lifeblood of that moat. But their strategic M&A has been crucial too.
The acquisition of Mellanox is the perfect case study. It was not a cheap deal.
No.
But it was transformative. It extended their technological advantage from a single chip, the GPU, into the entire data center communication fabric, that's Infiniband and Spectrum-X.
It let them move from selling a great product to selling an indispensable, fully integrated rack-scale system.
That's it. That integration is a key component of the lock-in we were just talking about.
And the way they return capital to shareholders, it speaks volumes about management's confidence.
It does. They operate like a company that truly believes their own stock is the best investment available.
How so?
While their primary method of returning capital is through massive, consistent share repurchases or buybacks.
Right.
While they do pay a dividend, it's nominal.
Right.
And that correctly reflects that they are still fundamentally a high-growth company where reinvesting every marginal dollar into R&D or strategic M&A yields a much higher return than just handing it back to shareholders.
Okay, let's transition to the raw financial quality, because this is where the picture of an exceptional business becomes just crystal clear. We have to talk about the profitability metrics.
They are simply staggering. I mean, they fundamentally redefine what is possible in the hardware sector.
Right.
Since the data center acceleration really took hold, we've seen gross and operating margins reach levels that are just. They're unheard of for a hardware business. We're talking consistently hitting 70 to 75% gross margins.
And what is the single non-negotiable conclusion we can draw from those 70+% margins?
Pricing power.
Yeah.
Pure and simple. Those margins are the clearest financial evidence of the deep, durable moat and the scarcity of their product.
Right.
It means the perceived value to the customer, the ability to train a foundational AI model, is vastly higher than the cost of producing the hardware. They dictate the price.
Because the cost of not buying their solution is economically devastating for the customer.
Exactly.
But the metric that truly defines a wonderful business, regardless of the sector, is return on invested capital, ROIC. This is how efficiently management uses the capital they put to work.
And here, NVIDIA it's in an entirely different orbit. Their ROIC is consistently and historically high. I mean, recent trailing 12-month figures have often been well over 100%.
100%.
Sometimes approaching 136%. Just for context, a company that maintains 15 to 20% ROIC is considered a fantastic business with a clear advantage. Hitting triple digits, that requires an explanation.
Okay, so how do you make 136% ROIC real for us? What allows them to achieve a number like that?
It's a convergence of two factors, and both are directly tied to their strategic choices. First, profitability. Those massive 70+% gross margins mean they are generating incredible amounts of profit relative to their sales. Second, and this is critical, is their asset-light model. They are a fabless company. They outsource the manufacturing to TSMC, which means their own invested capital base, the denominator in that ROIC calculation, is kept incredibly low.
So they're generating these extraordinary profits while only really owning R&D, design, and software. They have very little physical capital tying down their returns.
Exactly. High margins plus an asset-light model equals radical capital efficiency. A 136% ROIC is the undeniable financial signature of a company operating a unique, monopolistic bottleneck in a hyper-growth industry.
And this feeds directly into cash flow efficiency. High margins, low relative capital expenditure.
The net result is that their net income converts into free cash flow extremely efficiently. They aren't saddled with the constant need for these multi-billion-dollar capex cycles that integrated manufacturers like Intel have to deal with.
It gives them immense optionality.
It does.
And finally, the balance sheet.
A fortress. Just a complete fortress. They operate with a substantial net cash position. Their net debt to EBITDA ratio is strongly negative.
So they have flexibility.
Massive financial flexibility. It allows them to fund that crucial R&D, execute opportunistic M&A, and conduct those huge share buybacks, all without taking on any meaningful financial risk. The whole financial structure is just bulletproof. It maximizes their ability to execute on the AI opportunity.
Okay, so we have the gold standard business model, we have gold standard financial performance, but the market has priced all of this perfection in.
And then some.
And then some. So now we have to apply the critical lens because the price is already demanding decades of success. Before we hit the risks, though, let's just identify the primary growth engine that absolutely must continue to fire.
The single most important driver for their current revenue trajectory is, without a doubt, the capital expenditure cycle, the CapEx cycle of the global hyperscalers and the large enterprises.
Right.
They are building out what we can basically call the AI factory infrastructure.
This conversion of traditional data centers into accelerated computing centers is incredibly demanding. And we have to reiterate the current market dynamic here. Demand is limited by supply, not by customer need.
Right. That's why the price is so high and the margins are so strong.
But that powerful scarcity premium, it attracts powerful, well-funded enemies. So we need to focus on, two categories of permanent impairment risks.
That's right. Risk number one is existential, the potential obsolescence of CUDA.
This is the big one.
This is the single highest leverage point. For the entire investment thesis to break permanently, a competitor or maybe a consortium of hyperscalers, they must engineer a radical disruption.
What would that look like?
They'd have to create a new, open, or just superior software stack that is so simple, so performant, or so backward compatible that it triggers a mass developer migration.
The moment that switching cost mode is breached.
The 70+% gross margins are unsustainable, and the business fundamentally changes overnight.
So it's not just about a faster chip from a competitor. It's about breaking that decade plus of software inertia.
Exactly.
Yeah.
It would need to be an iPhone moment for accelerated programming, simplifying the experience so dramatically that developers willingly take on the cost of migrating. Until then, that moat holds.
Okay. Risk number two centers on geopolitical and regulatory action. Let's focus on the two sub-risks that could materially impact the revenue or the moat itself.
The first is continued and expanded U.S. export controls, particularly into the crucial Chinese market. China remains a significant portion of global data center demand. And while NVIDIA has cleverly engineered compliant, slightly restricted chips for that market,
Any further escalation could be a problem.
any further escalation that restricts sales of current or future flagship products would materially impair a sizable portion of their revenue and their growth potential.
And what about the regulatory risk, the antitrust angle?
This one is aimed directly at the moat. If regulatory body, say in the US or Europe, views the CUA platform as an anti-competitive bottleneck,
And they decide to act.
and they decide to act and were to force the licensing or the open sourcing of the proprietary CUEA platform, the economic value of the company changes instantly.
The switching cost just evaporates.
It disappears, and the underlying hardware, the GPU, would immediately begin its relentless slide toward commoditization, making it incredibly hard to sustain their current margins.
Okay, let's switch gears. Let's look at the upsides, the things the market might still be underestimating, the catalysts that could accelerate growth, even beyond this current trajectory.
The biggest one, and I think the one investors should be tracking most closely, is what's being called the inference wave.
Yep.
The current CapEx cycle is primarily focused on training AI models. That's the initial brute force computational phase.
But once you train a model, you have to actually use it. And that's inference.
And inference is a volume game. The coming wave of enterprise adoption for AI inference, running these large models for everything from, localized predictive maintenance to global customer interactions. That requires a much, much larger global volume of chips deployed than the training phase ever did.
So every company will need an engine.
Every enterprise, large and small, will eventually need an inference engine. If this mass adoption happens as widely as people predict, it will dramatically accelerate data center growth and extend this high demand cycle far beyond what current analysts are expecting.
And we can't forget the other areas, the ones that might graduate into mature revenue pillars beyond the data center.
Right. The non-data center pillars, specifically automotive, the DoDrive platform for autonomous vehicles and robotics with the Jensen and Isaac platforms.
They're using the same playbook.
The exact same software-first full-stack approach that worked so well in the data center. If these segments transition from just being high-growth prospects to being major, profitable, multi-billion-dollar revenue streams, they provide diversification and further validate the power of their platform model.
Okay, now we have to enter second-level thinking. We need to define the prevailing market narrative and then identify where the collective wisdom might be blind.
The consensus is pretty straightforward, right? NVIDIA is the shovel seller in the AI gold rush, protected by the CUDA monopoly for the next, say, 3 to 5 years, and that justifies this exponential growth. The transition from Hopper to Blackwell is seen as seamless.
But our analysis, while it agrees with the moat's existence, suggests the market is deeply underestimating two key internal risks, and they're both associated with their reliance on just a few customers.
The first is concentration risk. I mean, extreme revenue reliance on a small handful of hyperscaler customers. If Google, Microsoft, and Amazon collectively decide to slow their purchases, even for a quarter,
NVIDIA's results feel the impact immediately and severely.
right. And the second risk, which is more subtle and potentially more lethal, is the risk of self-competition coupled with a cyclical slowdown. We call it the air pocket risk.
Okay.
The market, I believe, is underestimating the pace and the effectiveness of the hyperscalers developing their own custom silicon, their ASICs, for their internal infrastructure. They are simultaneously the company's biggest customers and their most motivated, well-funded competitors.
Explain the mechanism of the air pocket. How would this actually look on a financial statement?
Okay, so imagine the hyperscalers, after years of this frantic buying, reach a point of CapEx saturation. They have a massive inventory of NVIDIA chips, and they've now sufficiently scaled their own custom chips, their TPUs, their Trainiums, to handle a significant portion of new internal demand.
So they tap the brakes.
They make a strategic decision to pause large external GPU purchases for, say, 6 to 9 months to digest that massive inventory and realize a return on their invested capital. This immediate slowdown in CapEx from their most crucial buyers would lead to a temporary but very sharp earnings correction. That's the air pocket.
The market is pricing in this perfectly smooth exponential curve, but CapEx cycles are inherently lumpy and volatile.
That's exactly right. And the moment that volatility hits, even if it's temporary, a stock trading at such a hyper-premium multiple can experience a brutal, brutal repricing. The duration of that air pocket is the key risk. If it lasts longer than a few quarters, the long-term growth story is at least temporarily fractured.
Yeah.
And this brings us to the final unavoidable hurdle, valuation. If the business is wonderful, the price you pay still determines your return.
Absolutely.
And NVIDIA consistently trades at these hypergrowth multiples, PE, and EBITDA, that far exceed its sector peers and, frankly, most historical norms for any business.
So why does the market allow this? Why do investors accept this kind of premium?
Because they view it as a scarce foundational technology utility, not as a cyclical semiconductor company.
Right.
The thinking is you cannot participate in the AI revolution at scale without their product. So the premium reflects the market's belief in the permanence of the CUDA software ecosystem and the staggering sustained rate of global AI adoption. The implied growth rate that's baked into the current valuation it's truly astronomical.
The reality is, buying at this hyper premium implies that you, as an investor, are pricing in decades of flawless execution and growth.
Mm-hmm.
Your expected return from this point forward is extremely reliant on two things: sustained hypergrowth and the market continuing to apply this premium utility-like multiple far into the future.
So if the price multiple is already so high, where do you find the margin of safety?
Well, for a high-quality, premium-priced business like this one, the margin of safety has to be internal.
What do you mean by that?
It's the quality and the durability of the business itself, the ROIC, the balance sheet, the moat that gives you the conviction to hold through volatility. But we can identify specific temporary setbacks that might create a more favorable entry point.
Okay, so we're looking for opportunities. What are they?
I'd say there are three primary ones. First, a technological misstep, a short-term product delay, or a manufacturing bottleneck in a specific generation that causes the stock to drop, even though the critical moat, CUDA, and the long-term AI trend are still entirely intact.
Okay, a temporary stumble.
Second, the cyclical hyperscaler inventory correction, that air pocket we just detailed. If orders slow for 6 to 9 months while customers absorb their purchases, the panic can create a sharp price dislocation.
That's a business problem, not a moat problem.
Exactly. And third, the simplest one, a general market-wide panic. If inflation fears or recession worries cause investors to just indiscriminately sell off all high-growth stocks, that could briefly allow you to purchase the stock at a multiple that's closer to its historical average before this whole hypergrowth phase began.
Right, below the dizzying implied growth rate.
Okay, so finally, we have to conduct the red team challenge. We must define the most compelling case for failure, the catastrophic scenario that would render this investment a spectacular overpayment.
The core downside argument, the risk that I think keeps analysts up at night, is that the AI gold rush is significantly front-loaded, and the buyers eventually transform into the most powerful sellers or competitors. The current price assumes hyperscalers will just continue buying GPUs at a frantic, ever-accelerating pace indefinitely.
So what is the sequence of events if that fundamental assumption fails?
Okay, let's detail the catastrophic saturation scenario. Step 1. The major cloud customers, having accumulated massive multi-year inventories of NVIDIA chips, reach a point of functional saturation.
They have enough.
Step 2. They simultaneously develop and fully scale their own powerful internal custom silicon solutions, their proprietary ASICs, to handle both training and, critically, the far larger volume inference tasks internally.
So they stop the purchasing cycle.
Yes. They dramatically slow or effectively halt external orders from NVIDIA. And this is the fatal pivot. Step 3. They begin licensing their own custom chips, like Google's TPUs or AWS's Trainium, externally on their own cloud platforms, positioning them as the direct, vertically integrated alternative to NVIDIA for their own cloud customers.
This instantly transforms them from NVIDIA's biggest customers into their most formidable, subsidized, and strategically motivated competitors.
That is the nuclear scenario. That confluence of inventory digestion, capex saturation, and new scalable internal competition would lead to a massive and permanent collapse of the current growth rate, and crucially, the premium multiple.
The market would reprice NVIDIA.
It would reprice NVIDIA not as a unique utility, but as a cyclical semiconductor company facing intense competition from its former top customers. And that would render the investment at today's hyper-premium valuation a spectacular overpayment.
So, to summarize our deep dive today, the bull case really rests on that unassailable CUDA software moat. It creates unparalleled switching costs, grants robust pricing power, and you can see that in the industry-leading 70+% gross margins and that exceptional 136% ROIC. NVIDIA is the foundational bottleneck for the single greatest economic theme of our generation, and it's guided by visionary execution.
The bear case, however, highlights the extreme concentration risk, the inherent volatility of that cyclical capex budget, and the hyper-premium valuation that bakes in decades of sustained, flawless success.
And we have to acknowledge the key man risk and the profound incentive their largest customers have to break that lock-in.
Absolutely.
Which leaves us with one final provocative thought for you to mull over as you integrate this deep dive into your own thinking.
The fundamental question is not if NVIDIA will continue to innovate. I mean, they are engineered to do so. The real question is whether their phenomenal pricing power, which is represented by those 70+% gross margins, can permanently defy the relentless gravity of commoditization when their own largest and most motivated customers are simultaneously their most well-funded and strategically important competitors.
That dynamic is entirely unique.
It's entirely unique in modern technology, and the outcome of that tension, well, the outcome determines everything.